After we've recently seen the S&P 500 witness this bearish breakout out of this ascending triangle, we have seen it stay strong as precious metals and energy prices have fallen. And so in today's video, we discuss whether this is also about to happen to the S&P 500 or whether we're about to see a continuation of this bull market. In today's video, we're going to have a look at the most important fundamentals and macroeconomics. And so let's waste no further time and start right away. By the way, if you like this approach of taking a look at the past cycles and learn from them, please make sure to subscribe to our channel and like the video so you don't miss future videos, and also support us here for our work on YouTube. Now let's have a look at the weekly chart of the S&P 500, and what you do see is the ratio between gold prices and the S&P here at the bottom. And we've marked the last few big crashes that we've seen happening to the S&P 500, and you may already see this relationship actually here. The last few times, for example, here in 2008, we've seen this crash actually coinciding to the ratio between gold and the S&P rising. Obviously, we have seen gold prices outperforming the S&P, and that actually marked the beginning of this massive crisis that we've seen here in 2008. And the same things also occurred here in 2020. It occurred here after we've seen this crash here in 2022. And also recently in 2025, we've seen that happening. And now it obviously makes a lot of sense when you do see this ratio rise. You do have this flight to safety with gold prices surging. And obviously the S&P 500 is crashing. But now if you have a look at what is currently happening, you do see that ratio actually rising without a big crash happening to the S&P. And that obviously would suggest we do see that happening in the next few weeks or maybe even days, because we are currently at those all-time highs. We are having those surging gold prices, or we have seen that happening, and now they've actually reversed and they are signaling deep structural concerns in our eyes at Kronos. And also if you have a look at the interest rates, you do see whenever they've been cut, that actually coincided to a crash here at the S&P, at the equities. And so if you have this this view on this ratio, on this empirical data that we've just assessed, obviously that would suggest we do see a crash happening to the S&P 500 in the next few days. And if you now have a look at what is currently happening to global liquidity, which is here on the 80-day offset, you do see if we have it on this 80-day offset, it beautifully aligns with the S&P 500 chart. Those tops are coinciding and those bottoms are coinciding. And obviously when you do see this global liquidity drop, that is also having a bearish effect on the S&P. And now what we are seeing here due to this offset that we've had is that here 2 months ago, we've actually seen this transition from quantitative tightening to quantitative easing. And so this transition here is exactly what you've seen happening to global liquidity. You've seen that having a major impact on global liquidity, and that might be happening in anticipation of what we might see until this date, until this 23rd of March, which obviously marked this this beginning with this offset here. And we might just see those tightened liquidity conditions lead to a crash in the next few days, weeks, maybe months. And so that's also one of the indicators that we'd like to take a look at, which is obviously having a major impact on the equities market. And you do see this beautiful correlation, and that is obviously also one of the bearish factors that we do currently see here at Kronos, in combination to this surge that we've seen at the gold price and also at the gold to silver ratio. You have obviously seen that big reversal here recently, and so it seems quite obvious in our eyes at Kronos that we might see a crash happening. You can see that beautifully here as well, that those big crashes coincided to this ratio actually rising here. That's what we've seen in the 2008 financial crisis. That's what we've seen in 2020. in 2020 and what we're currently seeing as well. And so we are quite concerned because of those developments that we've seen here, especially with those ratios, the gold to silver ratio, with the gold to S&P 500 ratio, and also what we've seen happening to global liquidity. We are having time ahead where liquidity is about to be a little tightened because we have not seen that liquidity that was injected since December with this transition from quantitative tightening to quantitative easing actually entering the markets yet. And so we do have that time frame until roughly March that we do have this liquidity still being tight because we have not seen the effects of quantitative easing. And you do see that those balance sheet expansions here in blue, they've actually always happened in anticipation of what happened next. And so you have seen that happening here in 2008. You have seen it happening here in 2020. And so it's it's really looking quite concerning because of those empirical evidences that we do see happening, that we do see actually really triggering right now. And so we are quite concerned and advise you to actually exit the S&P if you're actually invested in it. And so we might see a quite bearish opening today on Monday. And so obviously we do have just assessed the most important data concerning that. If you like this approach of taking a look at those key economic drivers that are actually driving the S&P 500, please make sure to subscribe to our channel and like the video so you support us, and also don't miss future videos. And if you want more of this content, you can also join our Discord server, which is also linked down below. And as always, please make sure to comment if you have any questions or want to give us your opinion about this topic. Thanks for your support. See you the next time. Bye bye.